banks are relying on life insurance. You keep your money in a checking or savings account, right? And then banks are turning around and saying, you know what? Let's back it up with something more safe, more secure.
Yeah.
Let's back it up with life insurance companies. Ain't that crazy?
Yeah, and they put the big sticker on all their windows saying, insured by the FDIC. And the banks are saying, well, that insured by the FDIC, maybe there's something better where it's insured by something that's state regulated, not federally regulated, that has these two guarantees. Let's put our money there instead. I mean, they're not even doing what they're inviting us to do, which is kind of wild. Today, Jeremy and I are going to pull back the curtain on one of the world's most surprising, the financial world's most surprising strategies. Bank-owned life insurance, BOLI. Yeah, it sounds like something you'd catch, but when we explore its historical roots and explain why it's become the cornerstone of financial stability for banks and reveal how the individuals, the you and me level, can apply these same principles through the infinite banking concept. By addressing some of the common myths and the compelling data, we're going to show you, we're going to empower you, the listener, how you can take what the banks are doing and just mimic it, because we know that success always leaves clues. And if we look what the wealthiest are doing and mimic that, we can be better off. So Jeremy, let's jump into this.
Yeah. So you mentioned bank-owned life insurance, and we know that a lot of banks tend to grow their wealth through loans and investments, right? But they also use bank-owned life insurance. So for those of you who don't understand what BOLI is, it stands for bank-owned life insurance and involves banks purchasing permanent life insurance policies on their key employees. And that's where the bank is both the policy owner and the beneficiary. Now, why would they do this? It provides stability, tax advantages, and long-term growth. And they've kind of turned these life insurance policies into one of the more rigorous, robust financial tools. And if it's all right, I'll give a little bit of a historical context before we kind of get into the meat and potatoes of this. But BOLI really became popular back in the 1980s. And over the years, it's more or less evolved into a significant asset class for the banks themselves. It contributes to their financial stability. And it wasn't until about 1994, due to some favorable regulatory changes, so just over 20 years or so ago, that it started really becoming popular. And since that time, BOLI, bank-owned life insurance, has become an integral part to providing stability and serving as tier one capital because it's safe, liquid capital for the banks. Its current relevance, since 2023, I believe you found that it was $225 billion is sitting in not death benefit, cash value. Collectively, $225 billion is sitting as cash value and bank-owned life insurance assets. And some of these big banks that we're thinking of are Bank of America, sitting over $24 billion, Wells Fargo, $18 billion, Chase sitting at just over $12.5 billion. All the way down to there's a little bank, I think it was 24 or so on the list in New York. They're sitting at just shy of $2 billion of cash value assets. Let that sink in for a little bit, Jason.
No, it's incredible. And the crazy fact is, Jeremy, since 2008, 2009, the housing crisis, the banks have 4X'd. Since 2013, they 4X the amount of BOLI that they have. Think of that. Like you just said, it's only been around for, at least it's been popular tier one strategy for the last 20 years, right? So Jeremy, when you think about how the banks grow their wealth and usually think about the loans, their investments, how they move money, how they're making interest on us. But BOLI tells a completely different story, doesn't it?
Yeah, it sure does. So simply put, the life insurance in there, it offers stability, it offers guarantees, predictability for the banks themselves. It helps them manage their risk profile. And because it's cash value, it is a tier one capital asset. That is a unique tool to help in volatile times. There's no other asset out there that matches the combination of benefits that you can get that banks are using for the life insurance product in and of itself. So a couple of the key points there, the Federal Reserve, why do they like this to provide stability? As of December 2024, the Federal Reserve's monetary policy, it tries to set a benchmark for the interest rate. And it came in at about 4.5% as of December 2024. And that was an article written by JP Morgan. Now, when banks we're in low interest rate environments, they try to get away from the lesser attractive assets like bonds And they started pushing banks to seek some alternative solutions that offer a little bit more stability and the guaranteed loans, because that's one of the reasons we like, banking with life insurance, isn't it? High cash value life insurance is the guaranteed returns that you have in it. So can you talk a little bit about the impact on their investment choices, Jason?
Yeah, sure can. I mean, as far as think about what you just said, like they're doing it because of the tax advantage. It's tax-free growth. They're taking loans out, like you said, and they can use these loans for other things that they need for their business. And they also have the guaranteed death benefits. Like they're literally making someone a VP, giving them more opportunity. You have a VP of everything in the bank now because they need an insurable interest. And then they're able to take the death benefit when it pays out and then use that as an investment. Like it is the perfect tool for them to be tax advantaged, to have the stable returns. And then they can also use it to, for the employee benefits funding. I think that's what you're asking me is like, what are they using it for? Like this real world data shows that banks are using something that is specially engineered whole life that we talk about in every one of these shows. And they're using it better than anyone in the world, if you ask me.
Yeah. Yeah. If we really break it down, there are a couple key benefits here for banks using BOLI, right? So we mentioned kind of routinely tier one capital. There's a regulatory compliance that banks have to have a certain amount of liquid cash available on their books. It's about 25% of the capital they have needs to be sitting liquid. Well, what better place to have it where it's guaranteed to return, right? So they use it, they funnel about 25% or so of their assets into high cash value life insurance. And that BOLI, well, it fulfills that regulatory compliance that they have, a very safe, stable, liquid asset that they can draw on in case something happens. Another second purpose for it is, like you mentioned, the employee benefits behind it. So in order to have life insurance, you have to have an insurable interest, as you mentioned. They have these key employees that they go through, like their managers, and they'll put the life insurance policy on that key employee. And in turn, the bank becomes both the owner of the policy, they have the key employee as the insured, and then guess who the beneficiary is? The bank. So what's crazy is if that key employee moves from, let's say, Wells Fargo to Bank of America, and Wells Fargo has that key employee life insurance on them, even when they move, they still own it at bank number one. So if that person passes away in the future, that tax-free death benefit goes back to the original source. So go back to the original bank that put it on there. Another thing that they allow them to do, have you heard of non-qualified deferred compensation plans? They're called NQDC plans for short.
No, I know you started writing, Jeremy, shared with me before the show that he started writing a book on this. I have not started writing a book on this, but so please, elaborate, bring the audience into your world and why you're writing a book on this stuff.
Okay. So NQDC plans, non-qualified deferred compensation plans. Your qualified plans are things like your IRAs, your 401ks, and a lot of these are regulated by the ERISA Act of 1974. When you provide or a company provides qualified retirement plans, it has to be available for every employee. But by using whole life insurance and the guaranteed and predictable growth that's inside of it, they can actually provide a non-deferred or non-qualified deferred plan for the upper management. Now, this provides effectively like golden handcuffs for these folks, right? You stay with us for X number of years, and guess what we're going to do? We're going to fund a pension-like policy or pension-like plan for you using the cash value of these whole life insurance policies. And then that death benefit can be used as an employee benefit, or it can go right back to the bank, giving the bank also tax-free death benefit, tax-free money. So NQDC plans, they're not just for banks. They can be used for other people with employees. It does create effectively golden handcuffs. You stay with me for X number of years, I'll provide a pension-like structure for you.
Which could be, like the way we're saying it, right, with golden handcuffs means that you're tied to something, you have an incentive. That's what we mean. But it could provide, like if they're making people and giving people opportunities to be executives to do the things that they want to do within that bank structure, it's also giving people the security, maybe, and the stability that they want to have a certain amount of money upon retirement. And by using BOLI, the banks are basically guaranteed they can do that, rather than tying it to the market or tying it to some other investment like equities and other things. It's really minimizing the risk to the bank And it's also giving that person, that executive, the opportunity to get something from it as well. So, we're saying, hey, the banks are using it, they're doing it in a really smart way. But it's also, if we're modeling it, like you talked about, you can do this in corporate owned. And I know we're not going there today, but we're also just saying, like, just think through the whole scenario, like both sides of it. From the employee side of it, that's made an executive, they're going to have a compensation plan after they retire. And maybe if the bank's really nice about it, when it passes away, some of that death benefit's going to go for their legacy. So
That's right. So another benefit that they use, banks using bank-owned life insurance, of risk mitigation for all the loans that they make. Now, if I were to go down to the bank or you were to go down to the bank and we get a loan, that's a debt for us. But what is that to the bank? It's an asset, right? It's an asset to them. So how do they secure that asset? One of the ways that they end up doing it is through bank-owned life insurance. And they'll end up using those loans. So if a borrower, like some of these borrowers will come out there and they're not just putting life insurance on those key employees. They'll sometimes put it on the borrower themselves, because if the borrower has a note out, a loan that's out, and the person passes away, well, how's the bank going to get repaid? They're going to get repaid through the death benefit. So they're using it as a hedge or a risk mitigation tool, even against their own customers a lot of the times.
it's fascinating stuff when you think about just the guaranteed nature of it, right? Like we talked about this in a previous episode where, these life insurance companies, they're only betting on one variable. How long are we going to live? And with actuarial science, they know how long we're going to live. So like when people start looking, like, what's the most financially stable place to have our money? What is the financial backbone of our economy and has been for hundreds of years, for over 200 years? It's mutually owned, dividend paying whole life companies. Hence, BOLI.
And talk about stable returns, another benefit for the banks, right? So bank-owned life insurance provide guaranteed stable returns, which also hedge against market volatility. Like you said, they've been around for over 200 years. There's guaranteed predictable growth that's inside of these. And while dividends are not guaranteed, the companies that you and I like to work with have been producing dividends every single year for over 100 years, despite what's been going on with global wars, pandemics, recessions, depressions. So that's
there for a second. Like, I'm always so impressed. Like, I ask people that all the time. I'll say, hey, this company's been 148 years profitable every year, or this company's 119 years. This company's 137 or 160, right? We only work with companies that have been profitable every year they've been in business. Why? Because we practice this and we want our listeners, our customers, our clients, partners to be able to participate in the same way, where they know that they have financial stability. They have control over their money. They have guarantees and multiple guarantees. That's a unilateral contract when you have your specially engineered whole life. Why? Because a life insurance company is guaranteeing you a certain percentage of growth. You may get a dividend, which is more growth. And since they've never missed, it's almost guaranteed. It's not. I can't tell you it is, but it almost is. And then at the same time, you have the guaranteed death benefit. So hence why we're talking about BOLI. Again, it sounds like something you catch or need to wash off, but it's not. It's actually a really good financial strategy that the banks have been pouring their tier one money into.
Yeah. Another key advantage, tax advantages, right? So this kind of goes a couple different ways. They get the cash value grows at a tax deferred. They can access it via policy loans tax-free. The death benefit is paid out tax-free. And even referencing the non-qualified deferred compensation plans, those NQDC plans, those, when it's transferred over as a pension like policy over to those key executives, that transfer actually goes over to the employee, the ex-executive, and that's actually a tax write-off for those businesses.
That's awesome. Think about it, because that's the other way we lose money, right? We talked about in another episode, what are the biggest risks to our money? It is going to be taxes. It's going to be inflation. And that's what we're talking about. We're talking about hedges against all of the risks and the market volatility we talked about. And so this is what the banks are doing. They're coming and they're just using what's been around forever, and they're using it in a really big way. I mean, they're putting big numbers. We talked about $225 billion in bank-owned life insurance. I thought we should repeat that. So when I started teaching this as a lesson in my calls, Jeremy, I would do the left side banks versus right side policy and go through all the benefits and then show the second guarantee of the tax-free cherry on top, the death benefit, the guaranteed estate. And then you ask, well, where, if you were looking at this, where are you keeping your money? Left side in the banks, at 4% if you have a high yield, or 3.88%, like I had someone talk to today, or do you keep it on the right side where that's a guaranteed number? It doesn't fluctuate. It doesn't move with the market. And then you get at the end, it's like, well, hey, the banks aren't storing their money in the banks. They're storing it in a policy. Where should we store our money? Is the end of it's kind of the question is, look what the banks are doing. Look how much they're buying. Do you think they know something we don't know?
Well, what's kind of funny about it is banks practice fractional reserve banking, right? So real quick, fractional reserve banking means they could take my dollar that I put into my checking or savings account, and they could take that same dollar and then lend it out up to 10 times. Now, for them, that's great, right? They're able to spread that dollar out. They're able to generate interest off of those loans that they're doing. At the same time, for society at large, it creates inflation. It creates instability. But again, when we're looking at stability for the banks, what are they doing? Even though they practice fractional reserve banking, they're going out and securing it again with life insurance. They're creating stability on their books by backing up the liquid capital that they have with life insurance in and of itself. So that stability that they have, where life insurance companies are providing a high level of liquidity to pay out death benefits, they're ensuring stability through the loans that they're making. I just think it's pretty interesting that banks are relying on life insurance, where everyone keeps their banks. Like, you keep your money in a checking or savings account, right? And then banks are turning around and saying, you know what? Let's back it up with something more safe, more secure.
Yeah.
Let's back it up with life insurance companies. Ain't that crazy?
Yeah, and they put the big sticker on all their windows saying, insured by the FDIC. And the banks are saying, well, that insured by the FDIC, maybe there's something better where it's insured by something that's state regulated, not federally regulated, that has these two guarantees. Let's put our money there instead. I mean, they're not even doing what they're inviting us to do, which is kind of wild. Like, you see those big FDIC stickers. I can see it in my head right now on the front of all the banks. Well, the banks aren't keeping their money there. Like you said, they're practicing fractional reserve banking. Their job, when we deposit money there, it's not like, if you think, is it an asset or liability to the bank? We know, right? We know it's a liability to the bank, and they have to move our money and keep the money moving in motion to make it make more money. And they're going to go make 400 to 1,300% on the money we put there, but they don't keep the money we put there. They don't store their money that they're making there in the bank where they want us to put our money. They put it in where? In bank-owned life insurance. So full circle. It's wild. It sounds like I just said a bunch of craziness, but if you keep researching and go down the rabbit hole, you're going to find everything that Jeremy and I are sharing. And Jeremy, like I said, he's writing a book about, the qualified plan. Go ahead. Say what that is again. That's a mouthful for me.
NQDC plans, right?
Yeah, it's a mouthful.
They're out there. They come in different, vanilla, forms. You can build it whatever way you want. But this is a great place for business owners with key employees who want to retain them for the long run. Like, it's an option and an opportunity to provide employee benefits. But guess who else is doing this? It's not just banks. There's something out there called COLI, or corporate-owned life insurance. So when you look at Procter & Gamble, Walmart, the Disney Corporation, McDonald's, big name companies, right? Fortune 500 companies who are also practicing the exact same things that our banks are doing. So it really needs to be like, think about this. Are banks doing something? Are they practicing something that you could do? Is this something that maybe, if banks are able to do it and corporations are able to do it, is it something that other people could do?
And that's kind of what you were saying, right? It's like, how does it feel knowing that banks are leveraging strategy that most people don't even know exists? And then now that you know it, what's stopping us from doing the same? What's stopping you, the listener, from doing the same? I mean, we're both practicing in our life. That's how we got here. We went down the rabbit hole multiple years ago. We own multiple policies, family policies. And we're just talking about, like, we're going to go through some of the common myths here in a moment that people are worried about, right? So what are some of those common myths that we hear coming up from our listeners that are responding? We start talking about bank-owned life insurance and COLI and different things. Like, what are they worried about?
Well, one big one, right, is life insurance is only for death benefits. Do you want to address that one?
I do. I want to talk about the name first. One of the things that you learn if you ever go and get your life insurance license is that everything's really logical. They call it life insurance. They don't call it death insurance. They're not saying like, hey, we know you're going to graduate someday. You're going to kick rocks, however you want to talk about death. But they don't recognize that it has all of these living benefits. It's right in the name, life, and it's actually whole life insurance. So they're saying, hey, you're going to live for a certain amount of time, and this will provide insurance on your body that you can use while you're alive. And that's what we talk about the most are the living benefits of this, right? It should be called infinite banking or your privatized banking system with a death benefit.
Yeah, absolutely. Because there's what? Tax advantage growth, liquidity, stability, all these other benefits that banks are using.
Protection against liens and judgment, right? You got protection against stability. And you talked about it a second ago with fractional banking. And then you alluded to that the life insurance companies do something different, right? And they do something that's called Austrian economics or based in Austrian economics, which is sound money, meaning that when you put $1 in a policy, in a premium deposit, remember earlier when I said that they're betting on how long we're going to live, how long they're going to collect money from us, and that's why they're so stable and so profitable? Well, they know when they collect those premium deposits, when we make premium deposits or banks make their premium deposits, now they have that money, and that's in the contract. When they loan money to banks, to us, to corporations, they're lending it from a general fund, from their general fund. So they're collateralizing or borrowing against that money. Well, the stability is you can't borrow more than you put into the policy. So it's sound money. That's backed by something. That's what sound money means. Like back in the day, before we came off the gold standard in 71, right? Gold and silver backed our money. It used to even say it on the notes, backed by redeemable for gold or silver. So point being is banks are putting their money where it's not fractionally banked, where it's not a fraction. It's banked backed dollar for dollar, right?
Mm-hmm.
So
absolutely. Yeah. What's another myth that you hear a lot of? Only the wealthy benefit from life insurance. We're talking about banks. So must be wealthy people, must be wealthy bankers, right? Only the wealthy benefit from life insurance. You want to address that myth?
I do. And it kind of made me laugh when we said this because we start off saying, have you ever thought that the wealthy are doing something different? That's something we say all the time. We talk about the Rockefellers and Disney and Ray Kroc and the banks. But when you read Nelson's Becoming Your Own Banker, you realize that if you understand the rules of the game, that this is for everyone. But not everyone's going to do it, Jeremy, because not everyone has a discipline to save. That's where it's a little different. Like if you're watching this, you'll see my hands up high. You have to be in the first job of making money first. And then your expenses have to be here. The space between my hands is our savings. And so the reality is anyone can do this and practice this and learn the infinite banking process. So it's not just for the wealthy. It's for anyone that has the discipline to save first, to pay themselves first. They actually love themselves a little bit more first. What are some of the other myths, Jeremy?
Other myths that are out there. Let's see. We have only the wealthy can do it. It's only for death benefits. Those are the two big ones that I'm constantly bombarded with off the top of my head. What do you have?
So what are some of the other myths? Yeah, of course, they make so much money off of whole life. The insurance companies are bad because they're making so much money off of off of their commissions, and they're getting paid and everything's so expensive. Well, if you know that it's guaranteed to pay you and your family a multiple of whatever you put into the policy, are the insurance companies really being greedy? Are they really keeping more money? No, it's set up in our favor. But people have been conditioned, right, to think, oh, buy term, invest the difference. That's not where we're going today. But they think term is cheaper because it costs so much less. Well, yeah, you're renting insurance for a period of time. And when you research it, term pays out, depending on where your research takes you, 1% to 2% of the time. So that means 98 to 99% of the time, the death benefit's never paid. So is it really cheap, or is it really the most expensive thing in the world? So maybe life insurance is just more expansive. because it's more of a guarantee. It's more contractually favorable to the person that's purchasing it. I think that's a big one for me is people are like, hey, yeah, I talked to a guy today. He read a book in his 20s. I wish I had written down the name of it, but he read a book in his 20s that talked about, and this is 40 years ago, talked about buying term and investing a difference. He's been doing that his whole life. I introduced him 6 months ago to Nelson Nash, to Becoming Your Own Banker. And when we talked today, he had Nelson's book out, all highlighted, asked me questions, but he's willing to make that paradigm shift. He's getting ready to buy a company car. He's like, I would have bought this with cash. I'm like, cool, let's structure this so you can use this. Let's protect your wife, your family, your loved ones. And so that was one of the big misconceptions is it's cheaper to buy term. That was a long way to say that.
So I think for right now, we're looking at some of the parallels between BOLI and IBC, right? Looking at bank-owned life insurance and the infinite banking concept. Banks use BOLI to secure tax advantage growth and stability. Guess what? Individuals like you and me can do the exact same thing. Both strategies involve accumulating cash value of life insurance policies. This does what? It provides liquidity, provides stability, provides flexibility. And all of that with the uninterrupted compounding provides long-term financial growth. And that's what I really like. So banks are out there doing it. Corporations are out there doing it. And it can come down to the you and me level as well. And that's what I really like about it. It's not just about storing your wealth away. The banks are out there strategically leveraging life insurance in the same way that you and I do it by practicing the infinite banking concept. And all of our members here can do it the exact same way too. It just really comes down to figuring out what's meaningful and what's manageable. How do you want this to be structured?
And I love how you brought all the way back to meaningful and manageable. Like what we're talking about are big numbers. We're talking about billions of dollars in BOLI. You know, we're talking about millions of dollars when we're talking about some of the billionaires that have this, right? We talked about Bill Gates. We talked about Warren Buffett having about $1.8 billion of whole life. So when you see, but we bring it back to you and me level, we know that we're helping people with much smaller policies, like meaningful, manageable things that they're going to do in their life. They're saving their money guaranteed in one hand. They're spending the same dollar by borrowing from the insurance company, and they have a guaranteed death benefit, right? So they got two guarantees, and you're turning $1 and using it in 3 places instantly. Like that's what we're bringing it back to. We're making a comparison. We're starting big with BOLI, but just bring it back to where your economic system is. How much money are you earning? Are you paying yourself that 10% at least or 20% every year first? Like, do you have that meaningful future, like to use Jeremy's words, that is planned out for where you want to go in the future?
Yeah, I would ask our listeners, what misconceptions might you end up having about whole life insurance, and what misconceptions that have been built over time, how is that holding you back financially? There's a lot of misinformation that's out there. And I want to say, first and foremost, thank you for tuning in. Jason and I put a lot of time, a lot of our own personal education into learning about this and uncovering a lot of the miscommunication, the problems that are out there. And that's one of the reasons we put this podcast out there, so that way we can kind of clear things up. We wanted to get on the you and me level, let you know that the things that the wealthy are doing, the banks, the corporations, the Warren Buffetts of the world, is accessible to everyone. I was just at a conference. I spent about 3 days in Atlanta, and I was listening. It was a wealth conference, and I was going through the whole thing. It surprised me. Guess what was up there for wealth? We were talking about how Peter Thiel in 1999 put $2,000 into an IRA, and in just a couple of years grew it to over $3 billion. And guess what? In 1999, Mitt Romney did the same thing, $2,000 to an IRA, and turned it into $100 million. But modern day contributions are set to $7,000 a year. We were going over strategies like that, and I was trying to expand my system and my financial IQ, my financial operating system. But one of the things that they brought up was there's a very wealthy third generation guy. And we talk about family offices, kind of like how Garrett Gunderson talks about them in the book, What Would the Rockefellers Do? Mm-hmm. He grew up with a family office. His father or grandfather actually started a bank. And as he was going through the story, like his personal story about the family offices and how his family practices, he gave a story of, hey, I didn't realize things were different for me until I was in college. And a friend of mine ended up saying he was going down to the local admissions office to talk about his loans. And he goes, what are you talking to the college for about your loans? And the guy goes, well, who do you talk to about it? He goes, I take a I take a loan for my, it's like, yeah, I got student loans too. I take them from, he called it the Wilson Family Bank. His last name's Wilson. He goes, what are you talking about? The Wilson Family Bank. I found out that this family has over 70 whole life insurance policies, accumulating to cash value over $700 million. Wow. This is the same guy who sold 80 something companies in a year, made over $1.27 billion in a year from selling companies. And his family started this 3 generations ago. So he's Gen 3, G3, and they're still expanding their banking system. And I'm like, oh my goodness. I didn't come up to the conference thinking that they would talk about family banking, but that's exactly what they're doing. They took something that's available to everybody and they're using it for him, student loans. He was just paying student loans with this.
And why? Why? Like, Jeremy, what you just shared, like, it might blow people's mind. We're talking about 3 generations, right? So you're talking about over a period of decades. But what you just said is we finance everything. We finance everything. We either pay interest or we earn interest or you give up the opportunity to earn interest. There is no other way. So what the Wilson Family Bank is doing, they're taking policy loans because they probably have it in their family constitution that he's able to take a loan when it's something to better himself, to invest in himself, his most valuable resource. So he can take a policy loan and he pays their family back. They keep the interest in their family.
And that's what his roommate couldn't get his head around. He goes, wait, you pay interest to your family? And he goes, wait, you pay interest to the government? I mean, it was just...
Who would you rather pay interest to? That's a great question, right? Who would you rather pay interest to? And I'm so glad you brought this up because you've been talking about, like, I told you, I can't wait till you teach me more of what you learn, like your IQ when it comes to finances. But we also touched on, we didn't talk about it yet, and I was hoping you'd go there like 5-6 minutes ago. So audience, this is not planned, but I was hoping that Jeremy was going to talk about your EQ as well. That's your emotional intelligence when it comes to money. Because what we're talking about might sound really foreign, but when you realize that money is nothing more than a tool, it's a means of exchange, it's a way, like, it's really hard to carry around cows. I don't know about you, but I'm not as strong as Jeremy. I can't carry around cows and sheep and go barter with people, right? So I need to be able to use money to go buy things and have things bought from me, perhaps, right? It's a means of exchange. It's a tool. It stays in motion. It's God's laws. What we're talking about are very much rooted in principles, but it has the 2 sides, the math and the mindset. So the math is the IQ, right? And we have to understand how to play the game. The mindset's the EQ. And so who do we want to be paying for our banking system?
So we talk about financial EQ, the whole mindset behind it, and those misconceptions that people really have about money, what money is to them. I think you need to, figure out how money comes into your life. We said in an earlier podcast, we're here to talk about the taboo subject of money. Nobody talks about money. Your friend gets a new job. You guys go out for drinks and celebrate. They might talk about the new company benefits. They might talk about their parking plan. They might talk about their contributions to their retirement accounts. Do they ever talk about what their salary is? Nobody talks about money.
Yeah. No, and they might talk, if you go to a water cooler, they might talk about their investments, how they're taking whatever's left over and trying to go out and make a big spread on it. But they're not talking about how are they paying for the things in their life and how much are they making? Because we're taught not to ask those questions because it's impolite. Why is it impolite? Why is it impolite? Like, ask people what they're making. Get comfortable with it. Be comfortable with money. We're going to have a whole nother episode. Jeremy doesn't even know this, but we're going to have another episode where we talk about inviting money into your life and about talking about making that a normalized conversation among your family and how can you do that? How can you structure that? But let's bring it back full circle to BOLI. We started talking about BOLI.
Folks can't go out. They cannot buy bank-owned life insurance. They can't do that. But they can buy specially designed, high cash value, whole life insurance, right? Ideally from a mutual company. What does that do? You can do exactly what the banks are doing. By having a properly structured whole life insurance policy, you get the tax-free growth, you get the liquidity, the control, and you have the opportunity to build wealth over time. That IBC it's not just about here in the present. It's about what's going to happen. Like I mentioned before, the Wilson Family Bank, that was 3rd generation. But you can still benefit today. You can start this process of doing what the wealth that you're doing today. And if you are thinking long term, think about G2, G3, G4. But it all has to start with a change with someone. Someone has to break the chains and someone has to start over. And ideally, that's you. If your family's not already doing this, ideally that starts with you.
I love that. And so you're like your action steps as listeners, it's just kind of evaluate where you are, really financially weigh in. We could talk about it all the time, but you have to, all progress starts with being honest with yourself, with honesty. So weigh in, see where you're at. Are you making more than you're spending? If not, well, then you got some work to do there. But once you are, then you've already heard about what the banks are doing to set their financial foundation. You heard about families, the Wilson family, who's been doing this for 3 generations, and they have 70 banking systems. Just imagine where your family could be if you decide to take action. Because at the end of the day, you can learn, go down the rabbit hole, do what Jeremy talked about in an earlier episode where he tried to punch holes in this thing. I did too. Not as much as Jeremy, because like his wife Liz likes to hear, he's really good in the sheets. I think more about the logic and the EQ of things. And if it's a principle that makes sense, then I'm all in. So if you guys weigh in, see where you're at, decide that you want to start generation 1, well then reach out to us, ask us questions, learn more. We're here to support you.
Yeah. And we'll give you a couple actionable steps, right? Your step number 1, you first need to evaluate your current financial plan. I want you to take an honest look at where you are and where your money is going. Are you funding your own financial growth, or are you relying on someone else's bank? Step 2, learn about the infinite banking concept and figure out how it tailors to your goals. Not mine, not Jason's, not someone else's. This needs to be meaningful and manageable and tailored to your life. This is your banking system. And step number 3, after you've gotten a little bit of education and you keep tuning in to us, sharing this episode with others, reading the books that we recommend, schedule a consultation, right? It's free. It's easy. Jason and I don't charge for your time. We don't ever charge fees. We just want to help establish the system. So take a look at where you are financially, continue to learn, continue to educate yourself and grow, and then just get on the phone with us. It's so simple and so easy.
Banks rely on life insurance because of a proven strategy for building stability and long-term wealth. With infinite banking, you can mirror this strategy by taking control of your finances, creating a guaranteed, how's that sound, guys? A guaranteed legacy for future generations. We listed the action steps for you to take the next steps. So Jeremy, close us out. We've been here. Everyone, don't forget to subscribe, share this episode, invite someone to come listen to it, and join us next week for more insights on building lasting wealth.
Yeah. We'll see you guys then. Take care.